hello, and welcome to the Business of Property podcast. I'm Stuart.
I'm Simon.
And I'm Simon.
And we've been finding, buying, and growing income from property for over 20 years, and we talk every week about the reality of running our property businesses. And quick request before we get into the all-important mortgage episode is if you haven't left us at least a rating or a review, please do so. And please do engage with us on YouTube. We've got a few people engaging with us over there now, so please do have it over there. But at the very least, do please leave us a review, as did Cookox. And I've tried to say that as carefully as I possibly could. But Cookox said, excellent podcast. I am a former home builder in my country. And since I came to the UK, I've been looking for help to get on the property ladder. Hearing this podcast fills me with confidence to go for it. Great information you share on it. Thanks and congrats. And then asks us if we thought about creating a boot camp or some kind of workshop. Yes, we have. And that is something that is in the pipeline, Cookox. But if you want to be a star like Cookox, please just leave your rating in your podcast player, and you too will get a shout out on the Business of Podcast. That's the paperwork out of the way. Now we get on to the meat and potatoes of the show. And as we all know by now, if we've got Mr. Glastonbury on the show, we're going to talk mortgages. Simon, the date of this recording, we are a day after the Bank of England meeting to discuss interest rates. And was there much to come out of that from your side? I'll hand over to you on that one so you can talk us through.
Absolutely, chaps. Absolutely. Welcome again. Good to be back on. Bank of England holding base rate again at 5.25%. Not a surprise at all from within the industry. It was a vote, I think, 6-3. Which was a more of a surprise, I suppose, that people are thinking, right, okay, we need to drop. I think we were all hoping for a drop rather than expecting a drop, and certainly in January, not something which we would kind of expect, certainly within the industry. Inflation is coming down, yes, but I think from the data received and the release then sent out from the Bank of England, they want to make sure that inflation is coming down at a steady rate, and will continue to drop down to the 2% target they want it to be. They don't want a knee-jerk reaction, which kind of makes you laugh because they soon put them up quick enough. And again and again and again, that sort of felt to me like a knee-jerk reaction. But they won't drop them in time, which is quite annoying. But I think certainly it's trending. If you want to word one of the words that kids use these days, it's trending towards an expectation of lowering over the. I would certainly expect first quarter. We would then expect to drop. That's got to be good news. It is. It's good news for all of us if that's the case.
Well, it is interesting, and it's a typical parliamentary term, isn't it? It's looking towards, possibly trending towards lowering, which basically means it's not lowering, and we'll talk about that in the future. But what was interesting and why we love doing this podcast with your good self is that both Simon and I had a quick chat when we came into the office this morning, and I think both of our sense was, rates must be dropping. I think that was already in my head of the title of this episode. But you shook your head immediately and said, no. Simon and Stuart, you're wrong. You got that wrong.
Yeah, absolutely. We've got you would expect, really, we've had this trend recently of interest rates dropping, certainly fixed rates. The media love to get a hold of this, particularly the delightful Daily Mail. And all over the place, rates are dropping, fixed rates, get your fixed rates here. We've got a few left just for you. And up until a week or so ago, that was generally the case. They had been dropping, both on the buy-to-let side and on the residential side, more on the residential side. And I think we touched on this in previous pods, haven't we? Where it was a very sort of interesting anomaly that the buy-to-let rates have not changed massively. I'll put a caveat in there, apart from the wonderful fees they've started hooking onto them. But the general buy-to-let fees rates have not really changed in the last few years since the rate drops. A lot of them have been hovering around the 5%, 5.5%. Yes, they have come down if you want to pay a nice big fee, and there are some much lower ones if you pay ridiculous fees. Those granted, if you take those out of the equation, hasn't really changed. The residential market, yes, they've been coming down. From when we last spoke about 6 weeks ago, residential rates have come down about 0.5%. Across the board, but in whatever sort of category you want to look at. Buy-to-let rates, similar, maybe slightly less. However, we're seeing over the last week or so, lenders putting rates up. Nationwide, for example, have put their rates up pretty much across the board, just over 0.5%. Now, the reasoning we don't know. That was announced yesterday. They haven't given a reason. If it's a business reason, I don't know. It's certainly one thing we know for sure is it's not because of the amount of business they're getting in at the moment, because that's somewhere near, probably somewhere near half they were getting probably the year before. So it's not business. So do they know
How
something we
widespread
don't know?
is it across lenders?
Pardon, son?
How widespread is it across the lenders? Are they all putting rates up yet, or is it just a few sort of leading the way?
I think it's just that's the question, which has then gone back out to the industry. Is everybody going to follow? Because no, it's only a few at the moment. So does that give us an indication? Is it a knee-jerk reaction from me, just saying, "Oh my goodness, what on earth is happening with the industry?" But it would give you Nationwide are big enough for us to sort of sit up and think, right, what's happening here? Why are rates going up? Did they drop them too much? Is the question. People are now looking at, we touched before, people are now looking at swap rates, what the swap rates are over the next 2 and 5 years. They haven't changed dramatically. So they certainly haven't. Yes, they've gone up slightly, but not a trend we need to particularly worry about. So why have they increased their rates up so much? I think it's something definitely to keep an eye on for everybody. There isn't any indication in the industry that these things are going to shoot back up. But again, a caveat in there: if people out there in the podcast world are looking, thinking, waiting, I'd suggest lock into a rate now, and at least you can change it as you go down the road.
One thing I would just pick up on there is you mentioned the wonderful fees. And of course, when you say wonderful, you mean gut-wrenchingly abhorrent. And I saw an email on that this week, so I got an email into my inbox and the headline was 3.06% buy-to-let mortgage. And I mean, the moment that landed in my inbox, to me, clicking open was, milliseconds, because I was like, oh my goodness, something's happened that Simon Glastonbury's decided not to tell me about, that something's going on really well. But of course, it was a wonderful marketing ploy, because I opened the email and it was so there is a product for buy-to-lets in a limited company that is 3.06%. So world's starting to look a bit brighter again. But then it tells me that it's a 65% loan to value, slightly sad. But of course, there was a fee attached to it, and that fee was 7%. And although we're not going to get into the numbers here, but for me, for the property I was thinking about that for, that would have taken me from the 65% loan to value that I mortgaged at to a 75% loan to value property. So this is what we're seeing coming through at the moment, in addition to what you're seeing.
Yeah, absolutely, and you're right. I mean, it's a fantastic marketing ploy. You've got to take your hats off to the lender, because they clearly know they're not going to be selling many of those products, because it just doesn't work. It's either the stress test won't work in the first place at 65%. Most limited company buy-to-lets I deal with are 75%. Simon, can you stretch out? Simon, how much loan can I get? Simon, how far can we get this valuation up? It's not, I've got a 50% product, I can go anywhere. I'd like more of those, but it doesn't generally happen because we're all investors. What we're planning to do is we're looking for the future. Right? When am I getting the next property? What am I looking at next? How am I going to get the funds to get that? So you're gearing up, not gearing down. But it's a great marketing ploy. Hats off to them. It's not far off from where they are. Just to give you an indication at the moment, limited company buy-to-lets, 75%, which is what I realistically look at. And I would have thought most people are interested in 3.79. So that still comes with a 7% fee. So is that now what I would then categorize as the best on the market? Now, this is individual, case by case basis. So it depends on the loan amount, depends on your individual needs. But to give you an example out there, 5.19% for a 2-year. This is an interesting one, guys. 5.19% 2-year deal with a £3,000 £2,999 fee. The usual caveats in there on advice. 5.19% for 2-year, 5.19% for 5-year with no fee. So around the 5% mark, I still think if you're then planning your portfolio, a rate at 5% over a 5-year period without a fee, that's pretty good money.
Is that personal or limited?
That's limited company.
Okay.
So I really do think that's good money, and that's certainly something to consider. Personal rates you can get slightly lower. We're not seeing the personal market. That's really dried up. So people buying in a personal name, what we would call accidental landlord, just buying their, keeping their existing property because they can't gear up enough now with the current stress tests. They just can't raise enough money out of their own house to then move on and keep it. It's not impossible, certainly, but
related to
difficult.
that and what Stuart was saying a bit before about these special offers. When they charge these 7% fees and add them to the loan, does the 75, 65, whatever percent loan to value limit sort of come into play before or after the fees are added, generally speaking?
Before.
Must be,
yeah. They will then add them on top. There are a couple of niche lenders who will want it included, but that's only generally if they're selling their book on. So
Stuart
most
could
part,
actually have that 65% loan to value product, but actually end up with a 75% loan.
Yeah, I think Stuart made a good point. The problem is
Happens.
you then create. You're then all of a sudden you're going, I've got 65% mortgage here. Oh, the following day, no, it's not. It's 75%.
Well, that was my point, and before, because okay, that's fine now, and of course, most of us are going to think this through. But right now, I get. Let's say I think fine. I've got 7% fee, 3.06. I've done my maths. Actually, I'm happy with that. The funny thing is, of course, you'd never do that for 2 years. But let's just say you did. In 2 years' time, I can no longer get this 65% product because my property is now 75% loan to value, unless there's been a significant move in the market. And this is the challenge also that people need to think about. When we are looking at remortgaging, and apparently there's going to be about 1.5 million of us this year in 2024 that are coming to the end of fixed terms. So there's going to be a lot of them thinking about this. So, in 5 years' time, I couldn't get that 60 or 65% loan to value product. And that for me is the irony and what we really need to take into consideration, because we know, therefore I won't get this, the preferential rates that a 65% loan to value would give me. So that is the added, thinking that needs to happen. Aside from the fact, would I give a bank, 7% of my the mortgage fee straight away? Not if I can help it.
Yeah, I mean, and it's funny in the sense that I have actually processed a couple of 7% fees this year already, because there are certain circumstances where people have just got to go for it, and haven't got a choice. That's the only way it can work. If they want to move away, if they want to raise funds, they're looking at they're just looking at cash flow and going, you know what, I'll take the gamble that property prices will go up enough in the next few years for it to make it worthwhile. Indications on that, I don't think their indication is there for huge capital growth in the property market anytime soon. I think we'll have, as it's done before, if you get the right area, the right property, it will grow. If you've refurbed it, it will grow. You will get some sort of market growth on it and capital growth, so you can then look again. But you've then got to price in what happens when that rate then comes to the end, and you're just then given the only option then you have is a product transfer / rate switch with the current lender. Your hands are completely tied at that point. You are literally given, what they have available at that time, and they're not necessarily very good. There are a few lenders who are giving really poor rates when it's for existing clients. Generally speaking, they're okay. Rarely are they market leading, for kind of obvious reasons. They don't need to do it, but generally they are okay. But the problem is you're then you're getting this fantastic rate again. You've just increased your loan size up by 7%, and in a few years' time, either 2 years, 5 years, whatever the case may be, property hasn't grown. You've got a much bigger loan, and you've got to go on. You're not getting 65% rates. You're getting 75% rates.
Yeah,
So they're higher again.
Yeah, and that's what we're saying, and that's before we even get into the fact that that's not going to come off your capital gains tax, but that's not going to happen today. But you mentioned that so in January you had a couple of people going for the 7% rate, which I find interesting. But just your general sense, just as we draw towards the back end of this podcast, is so we've looked at what's happening in the market, and it looks like there's a steady increase in sales, just as you'd expect post Christmas. But in terms of a general people coming to you looking for products and switches, what's your sense of the market at the moment?
In a word, quiet. I think is that it generally the general consensus throughout. I mean, we usually have that great uplift, rallying cry from the industry. Come on, let's go and smash 2024. I'm a little bit, as you can't tell by how old I am clearly, but you can see I've been in the industry long enough to know that just kind of doesn't work. You're going with market trends. Yes, there's always business out there. There's always business out there for brokers for whatever. We look at rate switches, etc. And people need to remortgage when their rates are coming to the end, and you need to speak to brokers. But on a purchase side, very, very quiet. It's still on the plus side. It's not. I make it sound doom and gloom. It's not doom and gloom, because clearly lots of people want to sell. You only have to do searches and have alerts put up from Rightmove, Zoopla, whoever your preferred sort of search engine is for properties. And even if you just do it in your local area, lots of properties are coming up. I do it for all sorts of different areas for different reasons. And the amount of properties which have come on the market is huge compared to what we've had probably in the last 2 years. It's really, really good. That is positive. Now, the difficulty in there is who's buying them, because from what we're seeing, it's the first-time buyers which are quiet. They're not buying. Now, if they're not buying at the bottom end of the market, and buy-to-let investors are not buying at the bottom of the market, it doesn't matter how many properties you've got, how many 3, 4, 5, 6 bedroom properties you've got further up the market, up the chain, they're not going to sell. Unless they come to a broker like myself and I can refinance it and then they can keep it. But generally speaking, people don't refinance 3 and 4 and 5 bedroom residential detached house to buy another one, because the sums just don't work. They have so much equity tied up, and if you have to leave 25% equity as a minimum in your 3 bedroomed semi in Surbiton, there's just too much money tied up in it. You want that money out to then move on. So the question is, when will first time buyers get back in the market consistently? And they're always there. There will always be a number. Of course, there's a caveat to everything. There will always be some, but I just don't think there's enough confidence in the market as yet for them to return. And maybe if we see the Bank of England rate drop slightly, that will give a little bit of a boost. And we've also got the pending election later on in the year potentially. So that might have, conspiracy theory, that might have some sort of influence in what happens as well.
I thought elections normally dampened the property market.
Well, yeah, quite possibly. I don't think we can dampen it anymore at the moment. I think that's the issue.
Another question sort of around trends or normalness. How does this January compare to a past or a normal January? I mean, is there normally a sort of uplift at the beginning of the year? I mean, you mentioned about sort of the industry and press and things being upbeat about the new year and going for it and things. Does that actually normally work, and we're just having a down year, or is it always lots of shouting and not that much happening?
No, I think January is usually fairly good. It is for me and for the business. It's usually fairly buoyant. People generally don't like talking about their mortgages, finance coming up to Christmas. Why would you? You've got
their mortgages and finances. Surely you talk about them all the time. Exactly. I mean, what else is there?
Well, yeah, absolutely. Should I look at the new scale electrics, or should I talk about my mortgage? I really don't know. But
mortgage every day.
Mortgages all the time.
My children
That's how sad we are, Simon.
They'll learn eventually.
Yeah, exactly. But we do usually see in January lots of inquiries. So lots of people just talking about it. And they ring up, I've got this to do. I'm thinking about this. I'm thinking about moving. We've looked. Rightmove always tell us every year, Boxing Day is the busiest time of the year for people searching. Is it? I've got better things to do on my Boxing Day to actually search for properties. But, that's what they say. Again, probably a good marketing ploy because everybody talks about it. But I think, going in, it's quieter than normal. I think that's because of the purchase market. And like I say, that's to do with, I think, first-time buyers. First-time buyers are not really my forte, but they do come in, and the guys within who work within the business, they have plenty of first-time buyers. Normally, they're not out there. Investors, again, it's quieting, waiting for the right property. Everybody wanting more money than they're probably worth. It's a usual story. There isn't any sort of isn't rocket science behind it. We're waiting for some sort of boost, and potentially, I think the boost will come with a drop in Bank of England rates.
So, Simon, I've got 2 properties on the market at the moment. Are you saying that my expectation that my expectation is just too high and I want too much? Is that what you're telling me?
Do you want the marketing answer, or
how long have they been on the market?
Broking answer.
Do you know what? It's a rhetorical question. It's fine. What I was going to say was actually interesting. So I do have 2 properties on the market, but interesting. One's only just gone up. And it's actually had a bit of interest. We've had 2 viewings, but and these are HMO properties, and more than, let's say, 250K for sale. Both of the people that have shown interest, cash buyers. So, wow. and again, this is just anecdotal, but I just found that really interesting because that wouldn't usually happen. And of course, all the things that we're talking about in terms of stress rates aren't usually applicable to HMOs because we're okay. But I just thought that was quite interesting as well. Mm-hmm. And I wonder, of course, it's a straw poll of one, but is that an indication of where people are at in the market, where there's just this kind of like, if they're fortunate enough to have that amount of cash, they'd probably rather invest it for now wait and see what happens with the mortgage market before they get the mortgage. Do you know what I mean? So I thought that was just quite interesting from what I'm seeing from a sales side, actually.
Yeah. It's interesting. I'm always very dubious with cash buyers because
Don't tell me that.
Yeah, no, not with you. I'm sure they're absolutely fine in your cases or the others. But because literally every time I ever look, I'm up against a cash buyer or said, oh, we've got a cash buyer. Strangely enough, in the back end, they've miraculously have to get a mortgage on the property. And why wouldn't you? You know, with HMO rates lower than 5% at the moment, that's good money on an HMO property. Why on earth would you put 250, 300, 400, whatever the figure is, into an HMO property if you just literally have the cash? I mean, HMOs are, as we know, we've talked before, brilliant, great investment. Very few on the market, though, or very few good ones. So
mine's really good.
It's in Plymouth. Particularly good.
I'll give anyone the postcode if they want to message me. It's fine. It's really good. We can, take the agents' fees out. Please put your fingers in your ears, agents. Contact me directly. But and on this, as we draw the podcast to a close, I completely agree because my first thought when the agent said, "Oh, they're cash buyers," literally the first thought in my head was, "Why?" Well, if I had 250, I mean, I'd be very happy if they progress with it. But I just thought, I wonder why you do that, because that is a lot of money.
Yeah.
So then, of course, I go to the same place as you, which is, and I've been there where you can put yourself forward as a cash buyer, whether that's with a bridging loan or you've got a very cast iron agreement in principle, and so you're going to just put yourself to the front of the queue. But I don't feel like we're in that sort of market where you need to do that sort of thing.
No, I mean the due diligence that I've noticed that estate agents doing at the moment, minimal compared to what they were doing before the rates were starting to go up. Before the rates were going up, they were doing absolutely everything, making sure you've got everything in place before you can even view the property. Now they're just opening the doors and say, "Come in, we'll take anybody," because they're not selling. And it's understandable. And in like your position now, if it's a cash buyer, it'd be interesting to see, okay, Mr. Cash Buyer, can I see proof? That's what they would have been doing previously. At the moment, I'm pretty sure they're just going, let's just show, because we don't really care if it's a cash buyer or not. We just want to sell the property because they're not selling very much at the moment. That's absolutely 100% cast iron. So, but with yours, because there's so few on the market, HMOs are very different, going for a different clientele completely. So if you did have cash, you're not going to buy your residential property cash, possibly, unless you've been left a huge amount of money. But with an HMO, yeah, quite possibly, it may be there. Get proof. Thank you. Is what I would say. Get proof.
So I was just trying to cheer me up at the end of what was,
of course,
a very sobering message for me trying to sell my properties. But of course, we are very grateful to have Simon Glastonbury share this knowledge with us on today's Business Property episode. For anyone that's gotten value, and I think we've shared bucket loads of value today, and certainly Simon Glastonbury has in the world of mortgages and mortgage finance. If you do want to reach out to Simon Glastonbury, his contact details will, as always, be in the show notes of this episode. So head over there if you'd just like to get some advice. And other than that, if you have got value, please do leave us at least a rating in your podcast player, Apple Podcasts, or head over to YouTube and subscribe if you're watching us on the video. So, and if you are, thank you very much for watching. Other than that, we'll see you in the next episode.